All right, let's jump right into this. If you've ever stared down a consolidated corporate tax problem, specifically question 1 of the IKIP's Summer 2026 tax exam, and felt like you were trying to solve a Rubik's Cube in the dark, you are in exactly the right place. Today we're unpacking the incredibly complex SSL Group tax computation. We're going to break down the total income, taxable income, and the final tax liability for the group, step by step, so it all actually makes sense. So here's our roadmap for this explainer. 1. Meet the SSL Group. 2. SSL standalone adjustments. 3. RFL depreciation and sales. 4. PAL navigating losses. 5. Group consolidation. And finally, 6. Final tax liability.
Okay, Section 1. Meet the SSL Group, setting the financial playing field.
Now, take a look at the stark contrast we're dealing with here. We have our parent company, SSL, kicking things off with an 8 million rupee accounting loss. Then you've got RFL, a wholly owned sub, just crushing it with a massive 150 million rupee profit. And then there's PAL, an 80% owned sub, dragging this heavy 52 million rupee loss. This wild mix of profits and losses, it sets up the absolute perfect scenario for leveraging group relief under the tax ordinance.
Moving on to Section 2, SSL standalone adjustments, untangling parent company deductions.
Right, so this perfectly illustrates the classic battle of accounting versus tax. In their financial statements, SSL recorded $8 million in financial charges for a vehicle lease. But as we know, the tax authorities literally do not care about the accounting treatment here. We have to reverse it. So we add that $8 million back to the income, and instead, we deduct the actual tax-allowable Motoraba lease rentals they paid, which is 9.46 million rupees. It just goes to show you can never take accounting profit at face value.
Next, we run into a withholding tax hiccup. SSL made 44 million rupees in purchases from a supplier without deducting withholding tax. Yikes, right? But wait, 20 million of those were imported goods, and the crucial thing to remember is imported goods are excluded from this penalty. So the tax rules only target the local portion, which is 24 million. Now the law says we treat 20% of that local amount as an inadmissible expense. So we do the math, and SSL gets a 4.8 million rupee add back. Honestly, it saves them a massive hit compared to penalizing the whole 44 million.
SSL also has some side hustles going on, specifically a return on investment in sukukus and some capital gains from listed shares. Whenever you see non-business incomes, I want you to use this mental model. Think of it like sorting laundry. Pull them out of business income right now, park them safely in their proper tax buckets, like the final tax regime or the separate block, and we'll deal with them at the very end. Oh, and while we're at it, we completely strip out that exempt 50 million RFL dividend and reverse the accounting loss they took on a machine sale.
So after parking those incomes, pulling out the exempt dividends, and fixing the lease and purchase penalties, SSL's standalone business income drops like a rock. We're looking at a heavy final standalone business loss of 70.66 million rupees for the parent.
All right, Section 3, RFL depreciation and sales, adjusting the profitable subsidiary.
RFL's adjustments are actually super straightforward. We calculate and claim tax depreciation of 4.15 million on their machinery. Simple enough. We also have to fix a bodged sales entry, which knocks their profit down by another 1.51 million. But look at this third point. This is where it gets interesting. RFL bought goods from suppliers who had national tax numbers but weren't fully registered under the Sales Tax Act. Do we penalize them for income tax purposes here? Nope. No adjustment is required in this specific scenario.
So, applying those quick deductions for the depreciation and the sale correction to their massive 150 million starting profit, RFL's standalone taxable business income is locked in at a very healthy 144.34 million rupees.
Okay, Section 4, PAL navigating losses, disallowances, and capital surrenders.
Now you've got to pay close attention to PAL, because they've got some wild compliance issues. First up, they tried claiming expenses for cash sales. The law straight up demands a 50% disallowance for that. So boom, we add back 12.3 million to their income. We also pull out a 7 million capital gain to park it in the normal tax regime. But here is the kicker, you guys. They had an 11 million rupee loss on Pakistan investment bonds. That 11 million PIB loss, completely walled off. You cannot set it off against their capital gain. It has to be carried forward. It literally cannot save them today.
So after hitting them with the cash penalty and offsetting their normal tax regime capital gain against their business loss, PAL's net business loss lands at 28.7 million rupees. Now, remember our ownership table from the start? SSL owns 80% of PAL. Thanks to the group relief rules, SSL can basically reach down and siphon up exactly 80% of that business loss. That means 22.96 million rupees is officially surrendered to the parent company to help shield the group.
Section 5. Group Consolidation. Merging the income streams.
Look at how beautifully this chart illustrates the magic of group relief. You combine SSL's huge standalone loss of 70.66 with RFL's massive profit of 144.34, and you get a combined group business income of $73.68 million. But wait, we bring in that surrendered loss from PAL. That $73.68 million is perfectly shielded by PAL's $22.96 million surrendered loss, dragging the final consolidated taxable business income down to a much more manageable 50.72 million rupees.
Almost there. Section 6. Final tax liability. Unparking the incomes.
See how we handle the different buckets of income here? Our consolidated normal tax regime business income of $50.72 million gets hit with the standard 29% tax, so that's $14.71 million. Then, we go grab those listed company capital gains we parked in the separate block earlier. That $12 million is taxed at a special 15% rate, giving us $1.8 million. And finally, the sukuks. Now remember, that $18 million we parked was net of tax. We have to gross it back up to $24 million before applying the 25% final tax regime rate, landing us right at $6 million in tax.
And there it is, the whole shebang. By combining the $14.71 million from the business income, the $1.8 million from the capital gains, and the $6 million from the sukus, we add those three streams up and we hit our final answer. A total tax liability of 22.51 million rupees for the SSL Group.
I'll leave you with this to ponder. Group relief absolutely saved the day here, heavily shielding RFL's massive profits from the taxman by utilizing the losses from SSL and PAL. But what if PAL hadn't met the strict requirements to surrender those losses? Just how massive would the SSL Group's tax liability be then? How much cash flow would have just vanished from the group? Mastering these specific consolidation adjustments about way more than just passing the ICAP exam. It's about real corporate survival. Thanks for joining me on this explainer, and keep questioning the numbers.